Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. It's been such a pleasure to get this podcast off the ground last fall. It's been so fun to sit down with top investors, money managers, strategists, traders, educators, authors, anyone else that I can put a microphone in front of, often virtually, and just talk about the current market environment. I think what's great about the financial industry, great about investing as something that you spend your time and effort on, is you don't have to do it alone. And part of why we created Market Misbehavior in the first place, why we do a podcast and a live market recap show and all those things, is just to empower individual investors and financial advisors to better understand the world around them, what we call your situational awareness as an investor, to learn the lessons of market history. And there are people that have studied so much more than you and I ever will about market history and about, what we can think about or how we can better anticipate moves in the market based on the fact that things have happened before. It's often been said that, the market doesn't repeat itself, but it often rhymes. It talk about history that in that way all the time. Today's guest is one of those market historians, sitting down with Sam Stovall, the Chief Investment Strategist at CFRA Research. Sam is honestly one of the best that I've ever found and been able to work with, who really understands market history, who can easily talk about previous periods and relate what we're seeing now to those other times. I feel like a lot of times as investors, it feels like we're in uncharted territory, pun very much intended there, and just trying to figure things out, as they go. And talking with Sam, you realize there are a lot of lessons to be learned. There's a lot of evidence of what has happened in previous cycles, and while we can't guarantee that the same thing will happen or anything going forward, it's the best we can do to try to anticipate how the market, how investors, how human nature-driven investors will react to new information as it comes out. In my conversation here with Sam, which I'm about to share with you, we talked about what's going right. We talked about the conditions going into Q1. We talked about opportunities for the market to move higher, starting with earnings season here in Q1, but other things you'd be looking for, signs to be optimistic. We talked about start of the year indicators like the January effect, like the Santa Claus rally, what happened this time, what sort of ideas that can help us understand about what could happen through the course of this year. We talked about balancing those seasonal indicators with current market trends and how do you relate what often does happen, what usually happens, with the evidence that we're seeing right now. And I thought you had a really interesting answer to that question. We also talked about some things to not be so optimistic about. We talked about how the markets often climb a wall of worry and what sort of things would be in that wall of worry kind of column that are potential headwinds to this market. Talked about valuations, talked about the return of small cap stocks as a leadership role, talked about market breadth conditions, which got weak, but not to extremely weak levels that have been part of previous extreme bear market cycles. Talked all about the Fed. We talked about year 3 of a bull market phase. And then at the end, I would encourage you to stick around to the end, because we talked about some work he's done looking at top performers in a previous bull market year and what that implies about their potential to lead in the year going forward. And he finished by sharing some of the names that he and the team at CFRA Research have identified out of those leadership stocks from last year, which ones may be best suited to outperform in 2025. A really fun discussion with a knowledgeable market strategist and someone who I've always enjoyed speaking with. So please enjoy my conversation here with Sam Stovall of CFRA Research. All right, it's a pleasure to sit down here with Sam Stovall of CFRA Research. Sam, I don't think you need much of an introduction for a lot of my viewers. I think people are familiar with you and some incredible work you've done over the years to educate investors. But thanks for giving us some time today. How are things your way, okay?
Things are very good. I hope your 2025 exceeds analyst expectations.
What a great wish for someone in the financial industry. I appreciate that, Sam. Very, very thoughtful. Start us off. I mean, obviously, there's a lot of uncertainty going into 2025, 2024, for the most part, an incredibly robust bull market phase. Ended with a bit of a question mark at the end of the year. Now at the beginning of this year, we've already had sort of an injection of volatility, some downswings, some upswings with earnings season kicking off. With all of that on your mind, I mean, what is your general sense of the market conditions here in January of 2025?
Well, I think that investors basically should be staying the course, but buckle up because I think we are going to be seeing increased volatility because of ongoing uncertainty as it relates to inflation, interest rates, economic activity, what the new administration is going to bring to the party, et cetera. So I think investors were a little blindsided with the market action post FOMC meeting. I think people decided to take profits early rather than delay them into the 2025 period. So they wanted to lock in what they could.
It's interesting, and I'd love to bring up. You have a series of charts that you gave me to go through, which I really appreciated. We're kind of showing, a moderate allocation in your presentation here, sort of a 45% equity allocation, and then other places. I guess, I mean, given the uncertainty, what would it take for you to start thinking more aggressively on offense? Is there a certain thing you would need to hear from a new presidential administration? Is there something new from the Fed or economic data? Or is it more just market conditions improve in some way? Like what would tell you, all right, we really need to ride this market higher?
Well, I think that by having a lot of the things you just mentioned would make me feel better. I mean, I do look at the consumer discretionary versus consumer staples, something that you do on your programs, and it's showing both on a large cap and on a equal weighted basis that consumer discretionary is definitely outperforming consumer staples. So the implication is that it still is a risk on environment. I think I am a little concerned about valuations on the S&P 500. So if I could see earnings come in around the 13% area this year that we expect and 14% next year, then that could certainly go a long way to make me feel better that this bull market has further to run.
It's interesting. I mean, earnings season just kicking off this week, and I guess the initial salvo pretty encouraging, right? With the banks reporting pretty strong numbers. Does that give you optimism about what we're going to learn here as fourth quarter earnings kind of roll out over the coming weeks, or is it a big question mark in your mind in terms of what we're going to hear from these next earnings reports?
Well, it does make me feel good, but it reinforces cynicism because in 60 of the last 62 quarters, actual results have exceeded end of quarter estimates. So it just reminds me that management does a very good job of managing expectations. So if we can get some good commentary on guidance, then that would make me feel a lot better.
Interesting. I feel like there's so many data points. Our cup runneth over with things to think about here, just in the beginning of the year, right? With all the things coming up. You have a number of things that you brought with you, just talking about some historical comparisons, which I think are really, really interesting. Can you talk through this one in terms of what we've learned so far, just in terms of the early action of the year, what to look for in the month of January, what that might imply for what the rest of the year may involve?
Sure. Well, I've learned a lot from many of your guests, one of whom is Jeff Hirsch and Yale Hirsch from the Stock Traders Almanac. So I just put together a table of those kind of indicators, following an up year in the market, what typically tends to happen. And, good return, not a great return, good frequency of advance or a batting average. So that was where we started the year. Santa Claus rally fizzled out. And so that basically says that we'll still likely see an up year, but it'll be muted. The first 5 days actually just squeaked into the positive territory, but likely could have easily fallen into the negative camp. We also realized a Q1 low of this year that undercut a last December low. So that's usually not a good sign and turns the likelihood of an advance into a coin toss.
It's, how much weight do you put on? I mean, obviously these are things that are widely documented. You mentioned Jeff Hirsch and his father, Yale Hirsch, which did some seminal work on seasonality. So many things that I feel like we take for granted now. How much do you weigh things like this, which are really, what has tended to happen with different scenarios versus how this year feels so unique in terms of the transition of administrations from Biden to Trump, in terms of a Fed rate cut cycle, which is not something a lot of us have experienced many of. How do you, I guess, differentiate the importance of a unique experience in 2025 versus looking at sort of general tendencies with these sort of indicators? How do you weigh those two?
Well, I sort of disregard the very short-term indicators like the Santa Claus
Mm.
rally, like the first 5 days. I mean, basically, everybody's trying to get a jump on everybody else, which reminds me that investors are no better than hyperactive first graders playing musical chairs. So I, I'm more a believer in the first month of the year. So as goes January, and in the first year of a president's term in office, if we got a positive January in that first year, we were up more than 18% for the full year, rising more than 90% of the time. So that at
Mm.
least offers some encouragement. But I always like to say that history is a great guide, but never gospel.
I love that. And I appreciate your sort of suggestion. When in doubt, zoom out, right? Think about some of the longer term themes and what could make sense. I was taught as I was learning about the markets early on, the markets climb a wall of worry. And I feel like that theme has come back so many times. Let's talk about the potential uncertainties or potential headwinds to this market through the course of 2025. What stands out to you?
Well, many things. First off, we were enthused to get a rate cut. The anticipation was very high, but once we got it, historically, the returns have not been that good. We're in the third year of a bull market. Traditionally, with rearing children, it's the terrible twos, but for the bull market, it's the traumatic threes. Also, we are looking at relatively high valuations in the large cap arena. Also, the expectation of a three-peat or three successive years of double-digit gains following a down year has only worked 1 in 5 times since World War II. So it's not something that I think, probability is just not there for an exuberant year.
I feel like, I mean, this is one of those challenges I feel like for investors for a while. I feel even during the extended bull phase of kind of, 23 into 24, there are plenty of reasons why the market shouldn't go higher, but it just kept continuing to pound higher. But again, I feel like it's not hard to come up with some reasons why we could have some challenges ahead of us. I'd love to dig into valuations a little bit, Sam, because that's one that comes up, and I'm going to jump around a bit on your
Oh,
presentation. I wanted to get
there
here.
it is.
Yeah, so talk to me a little bit about valuations. I feel like that's one of those things that during a bull market often gets floated as a reason why we shouldn't go further. But then bull markets just tend to plow through high valuations and make them higher. Given the run that we had in 2024, when you think about valuations now, what stands out?
Well, we have been seeing valuations come down a little bit. This is a 10-year average, and if right now with the S&P trading at about an 18% premium to its 10-year average forward PE ratio, that also compares with about a 36% premium on a 20-year basis. That has come down from a peak level that we saw in the middle of last year. Also, technology had been trading at about a 76% premium to its 20-year average, and now is at about a 34% premium to its 10-year average. So numbers that are high. I mean, they basically say that you should not be looking at valuations to time the market, but it gives you an idea of where the vulnerabilities might be. Conversely, if you look to the bottom right of that table, you see in yellow the mid and small cap indices are trading at near 20 and above percent discounts to their longer term relative PE. So versus the S&P 500, they look very attractive. And I like to say that fundamentals tell you what, but technicals tell you when. And right now we've been seeing a stutter step in terms of outperformance with the mid and small caps. So until we get the rate direction to be in favor of these stocks, I think they are going to continue to spin their wheels.
Yeah, I feel like the return of small caps was announced a number of times and it never really materialized in the last year. Is it an interest rate question? Is that what you would look for to really determine what are the conditions that finally cause small caps to go higher? And do you think that actually does come to fruition in this year?
Yes, I do. I mean, the way you were describing it, it's sort of like Brazil over the last 25 years has been the country for the next 25 years. So, small and large caps have been, where the place to be for the last 12 months or longer. So I do think that even though if we end up with higher tariffs, then that could benefit those group companies that are more domestically focused. Still, I think we need the tailwind of lower interest rates, since a lot of these mid and small cap companies are heavy borrowers in order to expand.
Oh, that's a really good point, Sam. One that I hadn't really thought about as much. I appreciate that. Let's talk a little bit about breadth conditions. And again, when I think of you, Sam, I mean, obviously you tend to take what I think for many can be a very complex macroeconomic world, and you tend to simplify in ways that I think really resonate with people. But I love how you combine sort of the non-technical with the technical in meaningful ways, particularly with this example, looking at sort of breadth, looking at industry or sub-industries, really. What is this telling you about the conditions now here going into early 25?
Well, this is a weekly chart showing what percent of the 155 sub-industries in the S&P 1500 index, that's the large cap 500 plus mid cap 400 plus small cap 600. So S&P's definition of the total US stock market. And what I do is simply monitor what percent are trading above both their 50-day and 200-day moving average. So every Friday, I show this chart, and we got down to a level of 10%, which is very close to the 5% threshold that usually indicates a pretty strong washout. So the 50-day looks pretty similar. Interestingly, however, the 200-day by itself still has further to fall. So this makes me sort of feel as if we might be bouncing along this bottom for a while until we get those two indicators in line.
Interesting, and I love that. I mean, we look a lot on in my work on breadth based on individual stocks and index members. I think doing it on the subgroup level is a really interesting way to think about. Thanks for sharing that work, Sam. You have a great quote on this next one. Wanting is more rewarding than having. Talk to us about rate cuts. The fact that we are now in a rate cut cycle, potentially with a pause. What's your research telling you about our current environment here?
Well, I went back to 1990 because prior to that, the Fed only told us about discount rate moves. But Alan Greenspan expanded the transparency of the Fed to announce Fed funds rate changes in his term in office. And so going back to 1990, we've had 7 periods in which we had the end of a rate tightening cycle and the beginning of a rate cutting cycle. And in those 7 times, 6 of them, we had nice advances, with the average being close to 19%. Yet, interestingly enough, once we do get that first rate cut, the average gain 6 months later is only 2%, and a full 12 months after is even less than that at 1.9%, with 3 of those 7 observations, or at least I should say 6, because we haven't gone 12 months out. But 3 of them were in negative territory because we had fallen into bear markets. So I think that the Fed's actions are still going to be supportive of how investors are thinking and feeling, but the track record is not there to propel the market that much further.
This is really interesting, and again, I mean, with things like the yield curve becoming more normal shaped with the first rate cuts. It's a little rocky often after that sort of initial signal, right? I mean, in long term, things have usually gotten much better, of course, but in the short term, it can be pretty painful. But when you're thinking about the Fed, obviously we've had a number of rate cuts now. Of course, big question mark in terms of what could happen. Inflation data earlier this week, all of a sudden reigniting a lot of speculation about whether we get rate cuts here at the next couple meetings and all of that. How do you look forward to those sort of meetings? What do you do now to sort of think about those potential future paths, how they could impact the equity space?
Well, first off, I wonder why we had such a great pop yesterday, but I think it was because there were a lot of shorts that had to cover those positions because expectations were for both the PPI and the CPI to show a much hotter reading. And we're still going to wait to see what happens with the PCE. 3 out of the 4 indicators, meaning the month over month, year over year for headline and core, 3 of those 4 are expected to show an increase, not a decrease. but I still think that the overall trend is downward. We'll probably end the year at about 2.5% on PCE and then move into the low 2% area in 2026. So I still think that that is important because inflation is the main concern right now. Employment is not a concern. So if the Fed's dual mandate, it still has a battle on its hands with inflation.
I feel like that dual mandate just rarely seems like they're in agreement. I mean, it's a tough balancing act. I feel like they have a job I would not want. I wouldn't wish it on you either, Sam, for sure. So you mentioned in your initial comments about the third year of a bull market, and again, often that is not as an ideal situation. Can you talk to us about some of the work you've done on previous bull markets? What that would lead us to maybe expect here in 2025?
Well, there have been 11 bull markets since World War II that celebrated their second birthday. And if you look at all 11 and say, what was the price change 12 months later? The average gain was only 2.2%. Even if you take out the three bull markets that became bear markets before the third year was over, we still only ended up with an advance of 5.2%. And that's because two more observations posted declines, but not enough to throw them into bear market mode. And three additional ones posted gains of only 6.6% or less. So really only 3 of 11 times, did we have a bull market worth writing home about. But I find that year 3 is sort of like demographics. If you make it to age 65, you've got a great chance of making it to age 85. If you get past the third year of a bull market, then, year 4 and 5 tend to sail along.
It's a really good point. You probably can't see the chart over my shoulder here, but one of the charts I look at every time when I walk in my office is just a long-term history of the equity averages in the U.S. And the main reason is just to remind myself that if your runway is long enough, I mean, chances are highly likely things are going to go up. It's just the path between now and then, and whether in one of those rockier periods. This is really helpful to illustrate that, Sam.
Well, and that's a good reason when people ask me or say to me that, investing is just gambling. I say, oh, yeah, well, then I would love to know which casino pays the gambler 80% of the time.
I haven't found that one yet, actually, now that you mention it.
No, neither have I.
To finish off here, and this has been fabulous, Sam. As always, I really appreciate your perspective on what we're all seeing here. Talk to us a little bit about, the names and the areas that were so strong in 2024, what that might mean for expectations here in the year going forward.
Well, in the beginning of every year, I get questions, Sam, should I buy last year's winners or last year's losers? And I tell them that the right answer to most financial questions is, that depends. And the way it depends is, was last year an up year or a down year? Because if last year was a down year, you definitely want to buy last year's losers because you want to rotate from first to worst. Or in New York, we say from foist to woist, but basically go from staples, healthcare, utilities into those groups that were beaten up the most. Following an up year, however, you are better off letting your winners ride, sticking with the 3 best performing sectors into the following year. And you traditionally end up beating the market by almost 300 basis points per year and outperforming by about 75% of the time. And it gets even better if you look into the top 10 sub-industries within the S&P 500. There you've added almost 800 basis points of outperformance with a similar batting average or frequency of outperformance.
Very interesting. And I think you graciously have provided some of those groups that are on that top list. What stands out looking at this list of potential ideas?
Well, a lot of these, like Captain Reno in Casablanca, round up the usual suspects. These are the usual suspects in terms of the better performing stocks in 2024. But take a look at the industries on the left, and you'll find a wide variety of sector exposure to, technology, consumer discretionary, industrials, financials, communication services, et cetera. And essentially, there are reasons that investors have purchased these stocks, and they tend to continue from one year to the next. What I did was I showed those stocks that had the highest CFRA equity analyst rankings, meaning a 4-star is a buy, 5-star is a strong buy. So basically, these have good fundamental and technical considerations going forward.
Some familiar names on here, the Alphabet, Tesla, etc. Others that maybe people are not thinking as much about. Corning, right, is one that doesn't immediately come to mind. GLW, but very interesting list, and I hope people can take these and think through them a little bit. Sam, this has been awesome as always. It's so great to catch up with you, and you tend to make, I feel like in uncertain times is when I'm happiest to sit down with you, because you tend to have a very level-headed perspective on what we're seeing and hearing. Where can people learn more about you and what you're doing at CFRA Research?
Well, simply go to CFRAResearch.com. There you can actually get free trials to our fundamental research through our Market Scope Advisor platform, as well as our technical analysis through our Lowry Research Group. Also you can take a look at our Outlook weekly publication that I write for. And so a variety of ways of finding out what it is that we have to offer.
Sam, you've done some incredible work, and I know we talked about when the Lowry Research Group sort of joined CFRA. I mean, what a fantastic database of market action, of sentiment and breadth indicators, and what a great addition to CFRA. But I feel like you are the best addition to the group there. Great to see you, Sam. I wish you the very best here in 2025. I hope we can catch up again.
Thanks, Dave. I look forward to it.
So I tell you what, Sam is honestly a genuinely wonderful human being, one of the nicest people I've met in the financial industry. It's always been fun to meet him. We didn't mention this on the podcast. I actually first met Sam through one of my mentors, Ralph Atkimpora. Ralph and I were working on a project for the MTA, now the CMT Association. We were both on the board at the time, and Sam came in to help, and Sam and Ralph had known each other for years. And I remember meeting Sam and talking to him, and I immediately realized this is just what a nice guy, and what a sharp and smart and knowledgeable investor. And it's just been, he has never disappointed with great perspective and just helping you make sense of things when it often feels like we're sort of spinning out of control with all the data points that we have. Talking with people like Sam, I think, is just a dose of calm, which is really, really helpful. I hope you enjoyed that conversation, particularly the end. I mean, I know from working at a large financial institution, what we would be able to do would be have smart people like Sam come through, talk about their perspective, and then say, here's, if I were you, here are the kind of things I'd be considering for my portfolio. And having people like that, and having access to people like Sam to get those ideas, made all the difference sometimes, just for just helping you think about what areas of the market where you could find some opportunities. So I'm really, really glad he was able to share some of the work there from himself and the team at CFRA Research. Really thought his comments, while I think there's so many reasons to be optimistic, obviously the markets have had a nice bounce so far in mid-January. His work on year 3 of a bull market and what has often happened, evidence based on previous rate cuts and what happens after that first rate cut. It's not all great. And I think, again, I came away from my conversation with Sam recognizing sort of that balance of things to be very optimistic about, most primarily the fact that stocks, generally speaking, are going up, and we're seeing things at or near all-time highs in a lot of places. But plenty of things that could cause the market plenty of trouble here in Q1 and through the rest of 2025. So a lot to think about. And again, I hope you enjoyed that conversation. Look forward to having Sam on the podcast later this year. By the way, if what we talked about, Sam and I, looking through the charts, looking through historical evidence, thinking about market breadth conditions and the trends in the markets and how to evaluate how some of these things are actually being manifested into price action of the different major benchmarks. If you want to do better with that, if you want to have a better market awareness or improve your situational awareness as an investor, our Market Misbehavior Premium memberships may be a really good idea for you to upgrade your process, upgrade your decision making, and improve your understanding of what's happening around you as an investor. 3 key parts about the Market Misbehavior Premium membership. First, our virtual courses will teach you all about technical analysis, behavioral biases, why we are hardwired to make poor decisions, and what tools and techniques and resources we can use to make better decisions, better buy and sell decisions, better risk management decisions, better money management approaches to help improve our returns and manage risk during uncertain times. We also have premium members only reports like our weekly flight plan, which we put out every week. It's where we look back at what just happened in the week prior. We look forward at the week to come and talk about particular levels, signals, and patterns we'll be on the look for. Also, our monthly chart review, where we apply our proprietary market trend model to a bunch of different asset classes around the world. Finally, access to a members-only community. You have the ability to ask questions anytime you want. I will be in there answering questions. Some of my other premium members, some that have been with me for years, might be answering in there as well. It's a great community. It's a growing community, and I hope you'll consider being a part of it. Go to marketmisbehavior.com/premium for more information, and don't forget to use the code PODCAST when you check out for 30% off your first 12 months on any plan. So marketmisbehavior.com/premium, and make sure you use the code podcast when you check out. That's it for today. Thanks so much for joining me here on the Market Misbehavior podcast. If you're listening to this on our YouTube channel, make sure you drop a comment. Give me some ideas. Who else should we be sitting down with? If you enjoyed the conversation with Sam, who else should be on the other side of that Zoom call when we have a conversation? I would love to know, and we're happy to approach anyone we can. For Market Misbehavior, I'm Dave Keller, and remember, it's always a good time to own good charts.